Welcome. We just got the closing bell for Tuesday, May 14th. We were expecting a muted and quiet day of trading, and for the most part, we got that. We were chopping back and forth between mostly the 522 and 519 region. And we did pause along the way at this line that we drew at 521 a few times, but for the most part, the full range was this 519 to 522 until the last hour and a half of the day, where we tested the 522 and we broke through it. We didn't quite traverse the entire region over here to 524, but we did get a lot of the way through, which was a little bit surprising to get this directional. Now, this is immediately before the CPI report comes out tomorrow. It's immediately after Powell said a whole bunch of stuff that should have scared the market. He said that, I don't think anybody could have expected that inflation would be this sticky. Actually, a lot of people like myself, and I know a few other fund managers who absolutely predicted that inflation would be a lot stickier, starting from the time when Powell was saying that it was transitory. It's transitory. And here we are 2.5 years later, 3 years later, and he's going, oh my gosh, who could have expected that it'd be so sticky? So that is basically saying we're not getting any rate cuts. There's no way that we could possibly have rate cuts because we're not making any progress on this inflation. And we need to, in his words, we need to wait for the policies to have their effect, which means we're not going to get any rate cuts, not anytime soon. Let's take a look at how bonds reacted and what we're pricing in. So we can see that we did come down finally from 8.7. I guess yesterday it already went down, so we didn't get much movement just for today, which doesn't make sense. That should have moved down much more. And then for July, it looks like, we're popping back up. It went back up. It went from down yesterday, and then from yesterday to today, it went back up after all of those comments by the chairman himself about how everything is sticky and we need to wait longer for policy to take into effect. So I don't know why we're moving up in probabilities for basis cuts. So this is what we would call, or what former Fed Chairman Alan Greenspan would call, irrational exuberance. There's absolutely no reason for us to get this exuberant and excited on poor PPI data and Jerome Powell coming out and basically saying we're not going to get any rate cuts anytime soon. So we only have irrational exuberance. The good news is it's not huge. Well, that's PGR. That's the wrong. It's not huge. Right? We undid yesterday's downward move from the open, and then we went above it a little bit. So just the fact that we have a slightly larger bar and that it went up instead of down, that is a little disturbing. The great news is that it's not huge. It didn't make it all the way to the all-time high. So this is really starting to look and smell like a bull trap. So if I wasn't already flat, I would have been scrambling to get flat in this last half hour of the market, because the chances are that the CPI data is also going to come in hot. If PPI came in hot, there's a really good chance that CPI is going to come in hot, higher than expected, and indicate that inflation hasn't been coming down. And if that's the case, then there's going to be a large reaction, or there would normally be a large reaction to the downside. So this could just be institutions doing a little bit of a head fake immediately before the CPI, just like we saw that ruthless trader over the weekend, or at the beginning of Monday yesterday, just come in and just take huge advantage of all the people who are on the Schwab platform who are unable to trade, and just pick them off in AMC and GameStop. So we're having a lot of games in the market right now, which means a lot of risk unless you know how to play the same game that the institutions are playing. But in my case, I would say, hey, it's way safer to, hey, they brought it up here. Let's take profits on whatever longs that we had. My shorts are probably still pretty safe. And then if this does turn out to be a bull trap, and we get a market that significantly moves lower or moves lower with conviction, well, I don't have any bullish positions to worry about, and my bearish positions will benefit from that. So don't get too excited would be my advice about this upward movement and getting close to the all-time highs. Right here, this 524.61 is the all-time high. We're pretty close to it. And if we do get above it, then yes, we can start screaming higher because there's a lot of cash on the sidelines waiting to be invested. But for now, I'm very, very skeptical of it. I could be completely wrong, and we could hit that 524.61 tomorrow and then move above it. But for now, as long as we're below it and as long as we haven't tested it yet, my expectation is that's a very strong resistance. And if we do test it, we are most likely going to fail on the first test. It will take multiple tests for us to actually get above that 524.61 level, most likely. Not guaranteed, but most likely. And this just looks like very much like a bull trap. So I'd be very, very careful tomorrow morning. If the trap hasn't been sprung yet, I would be very careful of taking bullish positions. So let's say tomorrow we open similar to where we close, or we open at 522.36, mildly down, just down to the next level and to the VWAP where we close the session. If we do that, I would not go long until I see us breaking above that all-time high. That would be actually a little bit above it, because we want to see it break above with conviction and not just get rejected and come back down. Right now, is timing wise in the market is going to be very tricky and very critical, because we could get trapped up here. And as people get enthusiastic about this market, we could just see a lot of fund managers or market makers just dump into the market at that point in time. And we don't want to be caught in that. We don't want to be caught long when the institutions start dumping into the market. So again, I could be wrong, but based on all of my experience as a former fund manager, even though my experience was in the fixed income space, well, that everything happened in that space before it happened in the equity space. So this just smells like a bull trap. So I'd be very, very careful. If you're going to play in small size. Don't go in with full allocations, because this is the type of environment where you can get huge swings very, very quickly, and something can go against you very, very quickly. So if you're going to play with small size. The other thing is that we will most likely see it in small caps, much more than we'll see it in the S&P 500. Why? Because most of the earnings in the S&P 500 are behind us. There's not really that many large cap stocks left. Where there is Walmart, I think, but was it Walmart? Let's see this week. Yeah, Walmart. There's Walmart coming up on the 16th on Thursday. But other than that, we're pretty much done with our large caps. So we have AMAT and John Deere, a couple others, but not a Cisco, not too many left over. So it's going to affect small caps more than large caps, most likely. And small caps are far more sensitive to interest rates than the large cap stocks. So an S&P 500, a Fortune 500 company, they don't have to borrow money. They do borrow money in order to leverage themselves, but they are not dependent on loans, and they're not dependent on their bonds. So they can easily weather interest rates, and they can negotiate better terms and better interest rates than a small cap stocks. For example, if Apple issues a bond, they're not going to have to pay nearly as high of an interest rate than if Zoom issues a bond. They would have to pay way, way more in order to finance themselves. So Or if they go to a bank and borrow some money, same thing. Apple, Google, Facebook, they're not going to have to pay nearly as much in interest rates than a Zoom or a GameStop or any other small cap. So these small cap stocks are far more sensitive to interest rates. And if interest rates are higher for longer, or we actually move up in interest rates, that's going to hurt the small cap stocks. And of course, if we move the other way, we get an unexpected rate cut, then that will benefit the small cap stocks more or faster or sooner than it would a large cap stock. So we're going to watch for potential whipsaws in the Russell 2000 tomorrow morning. And we're going to see, let's see what happened in TLT today. TLT drifted higher also. So we just basically came, touched that EMA 20, moved higher, but we haven't matched these highs right here. And we are still well inside this channel as well. So we could move higher, but really there's no good reason. Let's see what happened in dollar. Yeah, no real good reason. It did move down, but not significantly. It's still within, I can very easily draw a very narrow channel right here, but that this doesn't explain the movement upwards today. Well, let me just make sure I don't put my foot in my mouth and just double check. Yeah, this is already after market. It just chopped sideways into the end of the market. So this definitely was not what caused that movement upwards in the S&P. Let's check TLT. TLT, same thing, mostly chopped sideways into the end of the market. Let's take VIX. VIX did increase a little bit up into the market, which is end of the market, which is really interesting because with the market moving higher, you would expect VIX to move lower. But for the most part, it just chopped around in a kind of large range right here. It's only in the last few minutes did it start to move upwards. So what that's telling me is that the S&P 500 or the equities, they moved independently of everything else, which means that is another signal that institutions are playing games and that they're probably setting up a bull trap. So all of the action is happening only in stocks. You don't see it happening in, did this move in sympathy? No, yeah, so you don't see it moving, you don't see it showing up in volatility. You don't see it really showing up in, what is this? Same thing, TLT. You definitely don't see it showing up in, you definitely don't see it showing up in bonds, and then you don't see it showing up in currencies. This is the end of market right here, so we got to ignore this right here. You don't see it happening in currencies. So that is a big sign that this is very likely a bull trap. So let's not get trapped. Let's not get sucked into it. We still need to wait and see how that CPI report is going to come out. And most likely, given the PPI that we got, most likely it's going to come out hotter than expected. Food and energy year on year, 3.6 is the consensus. So what we can expect based on the PPI is, hey, nothing changed year on year. So we might get a 3.8 print, which is pretty far from consensus and completely outside of the consensus range. There could be a large reaction to, well, there should be a large reaction to that. If not, then we're back to how we started this video. Irrational exuberance. Irrational exuberance. What does that mean? That's the market just keeps on going up. Doesn't matter what the news is, doesn't matter what the Fed says, doesn't matter what the Fed does. It's just going to go up. And what is that? That's what we call bubble building behavior. So the term irrational exuberance was first used by Greenspan. I think it was in the mid or late 90s when he was describing how the market just kept going up, and how do you take that into account when you're trying to decide on monetary policy? And a couple of years later, we had the dot-com bubble burst. So he was describing the market as irrationally exuberant. So the danger right now in the market is that we become, or we could say that we've already become irrationally exuberant. And if we allow that to continue for a while, then we're setting ourselves up for a bubble burst. If it bursts soon, then we'll pop somewhere around this 530, 535, and then come down for probably a 10% correction. And if it's later, then we're probably talking about a pop in 2025 and then a recession that follows afterwards. So the sooner we wake up from irrational exuberance, the better it is, because then we don't have to go into recession. If it just happens in the next couple of months, all we have to do is have a 10% correction and then we can resume a bull market. If it happens after elections, it happens in 2025, then we are very, very likely, there's very strong possibility of actually hitting a recession. And that means probably going into a bear market in the S&P 500. And that could last anywhere from 6 months to 2 to 3 years, generally, is the average length. So more likely pushing towards 2 to 3 years, because the last one was the COVID one, and that didn't last very long. That was a flash crash and a V-shaped recovery. And we don't get those too often. So we would expect that if it happened in 2025, we would expect it to last longer because we already had our V-shaped recovery. We're probably not due for another one for quite some time. So if the markets are not going to listen to what the Fed is saying, and they're not going to listen to what the Fed is actually doing, then that is irrational exuberance. And that flies in the face of the market efficiency theory, where all known information is immediately priced in. We all know that markets are not perfectly efficient, but right now what we're saying is that there are times where the market is also not close to perfectly efficient also. It's actually kind of inefficient. And the last year or so should have proven it to you, where we've constantly been saying, hey, we're not going to get so many rate cuts. We're not going to get so many rate cuts. We're going to, when they were saying 6, we were talking about 3 or less. When they're talking about 3, we're talking about maybe 1 or 0. Now they're talking about 1 or 0, and we're saying basically it's going to be 0. So right now, this market, all this entire time for the last year and a half, they haven't been pricing in the actual information and the data that has been given. I'm not making predictions here. I'm just looking at the same data everyone else is looking at and reading the data, whereas these other people are looking at the data and sort of ignoring it or drawing very strange conclusions. What that means is there is probably a huge generation, entire generation of hedge fund managers who are currently in their mid 30s, early 30s, who came up in the industry just like I came up. I started in my mid 20s. I left the industry in my early 30s. But the advantage that I had was I started my career with a recession. I was on the desk for maybe 2 months, maybe 3 months, and then the 2007, 2008 financial crisis happened. I had a front row view of everything happen. I watched my actual firm, my firm's stock go to 0. I watched the entire meltdown. I was in this space. I was a commercial mortgage-backed security trader at that point and doing primary and secondary. And I was trading credit default swaps. I was trading swaptions, credit default swaps, CDX, CDS. Those were the exact products that were blamed for the downfall of the housing market and the start of the housing crisis, 2008, 2009. So I started my career immediately in emergency mode and immediately watching markets melt down. But ever since then, what has, let's say if you came in even just a few years after me, let's say 2010, okay, the end of that crisis, it was basically 2009, actually. So if you came in and you started your career at 2009 instead of where I started my career on the desk. I was an analyst before 2007, but I got my trading desk job in 2007, in September, October of 2007. And you can see immediately afterwards that was where we hit this giant recession. So if you just started a year or so after I did and you came in 2009, what recession have you been in other than COVID? You've been in this. Okay, you saw this, then you saw this craziness of COVID, but you saw a flash crash, which it did not only lasted a couple of months, 3, 4 months, and then you saw V-shaped recovery. So you don't know what it means to be in recession. You don't know what it means to be in a bear market. You know what a flash crash is, but you don't know what a true recession is, and you don't know what a true market meltdown is. Well, I guess you do know market meltdown, but you don't know at least what a normal lasting to multi-year meltdown is. You only know this flash crash. So you are evaluating based on these huge periods of bullishness, unprecedented money printing that happened during COVID and during the housing crisis, and actually during the 2012, 2013 era this time as well, because we were so fresh off of the housing crisis. The Fed at that time, Bernanke was, they call him helicopter Bernanke because he kept dropping money for no reason. He kept dropping money into the markets because he was so afraid of this happening again. So if you are in your 30s as a fund manager, which is not uncommon. Remember, I became a desk trader and a fund manager in my mid-20s. It only took me a year and a half to get to my portfolio management position. So I was a fund manager in my mid-20s. So you're talking about young guys in their mid-20s, late 20s, early 30s, who've never seen a real recession. And they're the ones making these decisions. They're the ones who are looking at the Fed and right now completely ignoring what the Fed is saying, what the Fed is doing. And there should be some older guys in their 40s and 50s watching over them, but right now it doesn't seem like it. They just keep being irrationally exuberant. So we want to be very, very careful. We want to see that the dollar, the bonds, and the VIX are telling the same story as the S&P 500. And right now they're not. The S&P 500 is the one that is deviating, which means most likely there are games being played inside of the S&P 500. It's not possible for the S&P 500 to affect the bond market because the bond market is about 100 times larger than the S&P 500. That's like saying I'm going to throw a drop of water in a swimming pool and it's going to affect the swimming pool. It's not. I mean, you'll make a splash. It'll ripple out a little bit, maybe 2-3 feet, but the rest of the swimming pool is going to be completely unaffected by it. But if I take the swimming pool, it's definitely going to push around a drop of water. So if there are games being played in the bond market, it's going to have ripple effects into the S&P 500. But if there's games being played in S&P 500, it's not going to affect the bond market at all. And so that's why when we see this type of weird divergence from the S&P 500 versus all the other things, the currencies, the bonds, the volatility, then we know that there is some sort of game being played right here. Right now, the one that looks like is being played is a bull trap where we're setting this upwards to kind of paint the picture that everything is great, everything's excellent. Look, we're near all-time highs. Like how amazing everything is. Everyone is so excited to put more money into this market, despite like we can overcome any bad news because there's just so much money in the sidelines waiting to come in. Well, most institutions won't play that game or allow their young fund managers to be blind for too long, and they will step in. So this looks like a bull trap. don't get sucked into it. If I wait until you have a clear break above the all-time highs, and most likely a break above the all-time highs and then a retest before you decide to go long in the medium and long term in this market. If you want to go long on a day trade basis, sure, there's room. There's the room from where we are to the all-time high is maybe a couple points on the S&P is not quite enough, but at least to this red line that we drew right here, the 530 level, that's enough room to play with. 2 points on the S&P 500. Well, if it represents a couple of points within an individual stock, then yeah, you can play on a one-day basis or an intraday basis, because that movement could. So let's see if I can find a good example. Let's say, okay, let's go for a meme stock, Hood. Okay, so Hood, in sympathy with GameStop and all of that, gapped up above the MA50 and then traded higher, came back down a little bit, but stayed above its MA50. Okay, so how much room do I have here? I have some resistance right here at 1850-ish. Okay, 1850-ish. Right now we're at 18. So tomorrow, if we move 50 cents, okay, that's 2.7%. And if I leverage using an option, I can do 4 to 10 times that. So even if I only do 4 times that, what did I say? Let's do that again. Okay, 2.77%. If I multiply that by 4, that's 11% in a day. That's not bad. That's livable. That's an okay amount of money to make in a day trading environment. If I happen to 10x it, then we're talking about 27, 28%. That's very good for a single day or a day trade. So there can be enough room to play on a single day or intraday basis in this environment, but you'd want to be so careful because you don't know when the trap will be sprung. And so you're going to have to watch this is true day trading, but every single second, you're watching every single bar and you're looking for the signs of a reversal and topping out, and then you're out and you take your profits and you run. So unless you are versed at doing that, or you want to play that game with a tiny amount of money just for fun, my recommendation would be just wait and see. Just wait and see. Wait until the probabilities are in your favor and it doesn't look like a huge institution with way more money, way more experience, way more capital, way more research, a much larger team than you have is waiting to take a large market action. It's better just to stay away from that and not be near it. So we're going to wait for the CPI to come out tomorrow. We'll see if we get a bull trap sprung or if we actually break through. Tomorrow, we will for sure get some volatility, and we will most likely, so even though we got this green bar and it did kind of poke its head, you can see from the daily chart, that movement upward really was not significant whatsoever. But if we are going to get some sort of significant, truly directional movement, it'll likely come tomorrow. Tomorrow or Thursday, because we do have several economic reports that collectively become very important coming out on Wednesday, Thursday as well. So this has been a wait and see week. I know it can be very tough, especially when it looks like, hey, things are kind of moving, but it was because we were mostly waiting last week as well. And like, oh, hey, look, Kane, it did move up. Well, it did, but not that much. Am I missing out by sitting on the sidelines? Well, maybe I might have missed a little bit of gains, but if this is a true bull trap and we get smacked way down, all of those gains are going to be erased and then some, potentially in a single session. So it's better just to not suffer that roller coaster and just wait until we have a high probability environment. Right now we have a low probability environment. So we're just going to sit on our hands and be patient until we have that high probability environment returned to us. We'll just wait and see what happens tomorrow morning. I will see you in the pre-session, and have a wonderful rest of your day.